Hey guys, it's Max Convexity. How's everyone doing? Happy Monday morning, the 23rd of December. I have a lot of good stuff to talk about this morning. Let's start with the Ultiverse like we always do, but then we're going to talk about the max factor, and we can talk about several things. I have a viewer question or a comment I wanted to answer. I need to throw away these USOY, QQQY, IWMY charts just to save room, but that's a year's worth of work and trades and blood, sweat, and tears. I just hate to throw it away. If anyone wants it, I'll give it to them. I don't know if it'd do anyone any good if someone wants it for research or something. Anyway, I have every trade in there for the past year, until like October. All right, so here we have it. Here is the positions. AMD, Baba, Kava. It's the usual suspects. Dell, DJT, HIMS, Mara, all the usual suspects. The only new one I noticed was one called TLN. TLN is something called Talon Energy. Let's check that out real quick. Talon Energy. Definitely, it's only been here about a year and a half, it looks like. $10 billion market cap. I wonder if these guys are in alternative energy or something, or maybe not now that Trump got elected. They're probably in the... Okay, so it says Talon Energy Company's independent power producer infrastructure company produces, sells electricity capacity and ancillary services into wholesale power markets in the United States. The company operates nuclear, fossil, solar, coal power plants. It is also developing battery storage projects. Well, in any event, okay, that's great. So Jay's got them in the lineup. Let's check out the ULTY grid and see how they all look. The far right is the average constituent in the ULTY grid. It's down a quarter point. ULTY itself is down less than half of that, of course, because of the option selling activity. That's what we expect. In a down market, ULTY is going to be down less, typically, unless it's a severely down market. But I made a video about that last week. But even in that case, ULTY would still be down, but would have some limit on the downside because of the caller strategies. And all of these positions are still callers. He's kind of turned this into a boring fund. I kind of liked when he could do anything, but this makes it easy to cover and easy to think about. Callers are easy peasy. Okay, so looks like MSTR is hurting us today, and Mara and Coinbase. I saw today that Bitcoin was down to 95,000, so it's obviously pulling back today. But on the good side, we have semiconductors, Tesla, Baba, Dell, Coherent, triple leverage NASDAQ. You never go wrong with triple leverage NASDAQ. NVIDIA and HIMS. All right, let's see what else we have. Let's check out that old index buffer report. We got some crazy prices in here. All right. I haven't looked. I should have looked at it before I came on this morning because SPY is basically not moving. It's down 11 cents. So the ones that are the standouts on the good side are FEAT, the New Dorsey Wright Fund, and 5E, of course, and T-SPY, and WDTE. On the bad side is iSPY, which isn't normal, JEPI, which also isn't normal, and SPY-T, which isn't normal. Those are three usually good funds. But anyway, they're pulling back today. So I just don't believe that ZVol's really down that much. I think they probably paid a dividend and it did not get taken out of the price. We'll look at Max's volatility metrics here in a little bit, but when volatility is going up, ZVol does drop like that. So we'll take a look at it. We'll take a look at that. But that may be a little bit of a red flag. If ZVol really is down that much, maybe there's something going on under the surface that I haven't picked up on yet. And plus, our volatility metrics and everything are still on cautious and have been cautious for like a week and a half now, or in other words, bearish. All right, in the NASDAQ side, KQQQ looks good, as does FEPI, as does YMAG. YMAG and YMAX are usually always on the good list. Now, YMAX did not make the good list today because of the exposure to MSTR and Coinbase and Coney and that kind of stuff. But YMAG, because of its exposure to semiconductors and big tech, is right there. All right, on the Russell side, they're all down. It looks like GPIX really isn't Russell. That's S&P based. I need to move that. I finally took Maxi off of here so we don't have to, so it doesn't mess up the scale. Riser looking good today. Riser makes money in times of higher interest rates. Higher interest rates also happen in times of inflation, or times that people anticipate inflation. After Trump got elected, for all the other good stuff that we're anticipating with him, less regulations and the good stuff we're anticipating. There's bad stuff also we're anticipating too. And a lot of his proposals, he's promised a lot of money out, but he hasn't said how he's going to pay for it. No tax on tips. Well, and not to mention he's going to give a big corporate tax cut. No tax on tips. So he's going to cut taxes to the middle class and to the upper class. Money has to come from somewhere. He hasn't said where he's going to get it from. So that the bond market is calling BS on him, and rates are going up right now. So that's helping Riser out. So if you're a Trump realist like me, Riser should be a good fund for the next year because inflation's going to go crazy. Not even to mention the tariffs. And I'm not saying it's a bad thing. I'm not saying I want Biden or anything. I'm just saying inflation's going to be lit. I mean, it just is. That's what tariffs do. That's what it does when you give everyone a tax cut without a way to pay for it. I know that they have some ideas and stuff, some concept of plans, but until, we'll see. Anyway, Riser's a good kind of defensive stock for the Trump era. Riser would make a good combination with something that's bullish on Trump, like say, small stocks. Russell's really the Trump trade, the more American, American first. But a long Russell position, but then hedge that with the position in Riser in case inflation does get out of control. Whatever. Because inflation and interest rates kind of go hand in hand. All right. So that's my political message for the day. All right. So let's see what's going on YieldMax universe. And the Bitcoin ones are pulling back. That one's, I guess, Maxi, or that one's YBit, I should say. Bitcoin's pulling back. Everything else looks great. Okay, now I had a bunch of other stuff I wanted to talk about. I don't want to miss any of it. So this is something I wanted to talk about. I got a comment on a video. Okay, here it is. This is from I don't know the name. It looks like maybe Ellie something or anyway. But I had suggested before, it was a few videos back, but we're going to get into the retirement simulator. So now's a good time to talk about it. But I had suggested in the retirement simulator a portfolio. And let me see if it's still up. I thought maybe last night I had to take it down. I think I did take it down last night. No, it's still up. Okay. So it's just a portfolio of three stocks. There's a growth ETF called XVOL. It's from Cruence Capital out of Dallas. I think it's the Cruence Capital. It's also managed by some people that are quants and do some like data science stuff named Drawbridge. But anyway, it's an interesting fund that has exposure to the S&P 500. But at the same time, it has a constant aggressive VIX hedge, which is a VIX call hedge. So that VIX calls do well when the market goes to shit. So I like XVOL. Then I was also, just because I've kind of had similar names, but also because they all would use volatility, and somehow I thought maybe a portfolio of 70% XVol and 30% SVol and 10%, that should say ZVol, because the ZVol is the more risky. It's debatable if ZVol or SVol is more risky, but in my opinion, so that's why I allocate like this. So that portfolio over the past year would have generated, if on a $500,000 account, would have generated about $32,000 of income, or almost $2,000 a month. So not a bad portfolio. No, no dead factor, which is no dead stands for decay, erosion, and depletion. They're all different things, but a lot of people just lump them all in together, and just anytime the stock drops, they call it erosion. So I made a stat that does that too. If the stock drops, it goes into there. But anyway, so it's the most bearish view of erosion, and this has none. Compared to some other portfolios, I was building the FEAT portfolio last night, the feature portfolio, and I was also building the feature portfolio. So on this one, I did the feature portfolio 60/20 plus the Dorsey Wright feature. So on this one, look, this gets $4,700 a month income. Anyway, this ZVol and SVol, all I wanted to say is I think it's a decent allocation. There's probably better allocations out there. What I wanted to react to, I got off the track like I always do. Some of you might find this interesting. Okay, so let's reply to this. What about 80% VU instead of XVol, 20% ZVol? More NAV appreciation with VU, and that's definitely correct. Or 60% VU, 20%, or 60 VU, 20 ZVol, 20 SVol, and you get some hedging with the SVol portion. Okay, that's what I wanted to react to. SVol actually does not give you hedging, and that's the only reason I wanted to react to that. SVol and ZVol both only do well when the market goes down, or when the market goes up. SVol and ZVol are short volatility. They're just like being long the market. They're just shorting. It's a short volatility trade that's long the market through another way. And I can prove it to you. Or you just got to trust me on it. I could bring up charts, but SVol when the market goes down, SVol and ZVol get killed. Okay, they're bull market funds. So I'm not saying it's not a good idea. I agree. The VU would have more appreciation. I'm kind of halfway agreeing with this person. Yes, the VU would have more appreciation. Absolutely. And then you could do their combination. That's great. The reason why the VU has a little bit more appreciation than XVol, which is the fund that mimics the S&P but has the built-in VIX hedge out of Dallas from Accruance Capital, Rob Emmerich. The thing about that, the reason that fund makes slightly less than the VU is because the VU doesn't have a built-in 24/7 VIX hedge. XVol was actually up in August, and not up just a little bit, up huge on the day, the biggest down day of the market. XVol was one of the only funds that was up, and it was up gigantic because its VIX hedges kicked in. So I don't think comparing XVol and VU are fair, because XVol has a hedging portion of it. But I'll agree with the person on this. Let's say we do VU's good. I'd say let's do 40% VU and then 40% XVol to get a little hedging. That's 80. And then 20% SVol or ZVol. But SVol and ZVol are both just bullish bets also. They just kind of enhance your bullish bet. But yeah, there's nothing wrong with VU. But I just wanted to make sure that SVol is not a crisis. If the market crashes, SVol's not going to do well. All right. So I think I could show that. This is, and I love SVol. It's a great fund, but you could see it's the same thing as the stock market. I could overlay a chart of the S&P 500 and it's the same thing. All right. Now, it doesn't mean it's not a great fund, but it just does not have any characteristics that make it make money as the market goes down. That would be XVol. Now look at XVol. Let me zoom out here. Oh yeah, you see this candle right here in August? For one day, this fund was, the next day, whenever the crash didn't happen, volatility came back out of the VIX, their price went back down to normal. But if the market would have crashed, this thing would have kept going up. And as it was, the hedge didn't really cost any money, because even after volatility came back down, the fund itself was still back where it, basically where it started from, and started gathering capital again. Now, this is a great fund, and this has a built-in VIX hedge. So I really like this fund. I say use this fund with SVOL and ZVOL, but throw in some VU also. But just be aware, VU, yes, has a higher return, but it has less safety because it has no VIX calls. Does that make sense? All right. Sorry if I got off track there. So now let's talk about, let's just look at the market, see what the market's doing today. And we'll also look at Max's volatility metrics. Let's just pull up the good old SPY. Let's put it on. Well, that's fine. I mean, let's put it on 30-minute bars, though, because daily bars look like everything's all right. And then 30-minute bars, I look at both of them, but I usually base my option trading decisions, because I buy options. If I buy options today, they're going to expire Friday, or, a couple of days, and maybe next week generally. But I use the 30-minute chart to time the entries and the exits. But right now you can see this damn gap, and it's the election day gap. It's the Trump gap. Every time the price goes back into it, buyers are there. Buyers were there this morning. So, okay, now let's see what Max's volatility metrics telling us. So the gap's holding for now is what the charts are saying. We're bullish above the gap. And of course, under the gap, we're bearish down here to this next one. Okay, so the volatility metrics, well, I'm going to put VIX up here. I'm going to show you how this works. Okay, when VIX is going up, it generally means the market's going down, or it doesn't mean the market's going. And when VIX is going up, it's because people are hedging their positions in the market, are buying options. And it also could mean volatility in the market is going up, or a combination of both. Well, anyway, so as soon as we see that happen, and on the shorter time frames, it happened back here. That's why we switched from bullish to bearish. But you can see the last time we switched from bearish to bullish was a good signal. Now this time right here, this doesn't always work. Right here, people were putting on hedges, but the market went up anyway. Sometimes volatility will go up at the same time the market will go up, but it's the exception and not the rule. But the converse is when volatility is going down, that's when we draw a green box here. That usually means clear skies ahead for the market. It definitely did there, and it definitely did here. These little marks are days. These are 30-minute bars, but you can kind of see the trend. But anyway, then sure enough, the market, people started putting on hedges, and then a couple of days later, what happened? The market drops. So we watch this every morning. We're still cautious on this until we see volatility would have to drop more. Now, it looks like it kind of is right now. VIX is on the low for the day, it looks like. But we're looking for this. I know it's just a line on a chart, but this 200 period moving average is kind of what we use. Whenever it's above the 200 period moving average, volatility is and trending up, we stay out of the way of the market. Generally bad times to be in the market. That's how this works. So look, you can see right there. You can actually, the blue line's the 200 period moving average. I compressed it, but it actually got above it for the first time back here. That's why it switched from green to red. So we've been cautious. And for a few days, I apologize. I said, I'm sorry, this isn't working lately or whatever. But then what happened the next day? Then we got that freaking huge drop. And then we even Friday of last week, we even tested lower, but we bounced. Now we're right back in the middle. If it doesn't sell off by the end of the day, it's probably clear sailing till the end of the year. Praying, that's just my opinion. I bet this volatility gets below the 200-day by the end of the day. I bet, especially if people sell their hedges. That's the thing. I can't predict the future, and this system doesn't try to. It just looks if people are putting on hedges or not. So when this is going down, it means people are taking off hedges. So, but anyway, we're still a long way from the 200 period moving average in this one. So you would still say volatility on this metric, which is VIX of VIX, volatility, still definitely elevated. So we're definitely going to stay cautious. It's not a guarantee. It doesn't mean go out and spend all your money on puts, but we're just going to, it means to me, the path of least resistance is probably to the downside. Now that's my, and that's the system talking. That's where I get in trouble. I made a video yesterday and I'm making another one today. And I said, emotions are enemy number one in trading. They're enemy number one in life in general, I think. Don't tell my mom I said that, but they are. Anyway. All right. So what else can we get ourselves in the middle of today? I wanted to talk about, but anyway, thank you for the letter. And I agree, but I did agree. Their allocation would work also. My allocation had more protection for a bear market. Their allocation had more, was more perfectly allocated for a bullish market, but that would definitely work. So I just wanted to answer that. Okay. Then yesterday I'm going to have a show on the max factor. I just released the max factor ratings for the end of the year. God, I was up late working on them last night. Okay, good. I had to put all the new Dorsey Wright stuff in here, but the problem was in MSTR is not a year old yet. It wasn't founded till February of last year, so it's about 10 months old. But I added MSTR to the max factor early last night so we could see, so I could simulate, in the retirement planner, so I could simulate the FEAT portfolio and the FIR or FIVI portfolio. Okay, but anyway, on the max factor, which is just kind of a general risk adjusted reward. Let's see. Okay, the worst funds: TLT, bond. CTA, that's a commodity trend following fund. That's actually a great idea, but it just hasn't been working lately. BNDI, that's a bond fund. These are the worst. This is where you get the smallest amount of return for what you're risking. Okay. Now these are the best funds. And there's the best ones on this list. MSTR is not on this list yet. If it was, or MSTY, or neither of them are on this list. If they were, they would be up here even higher than NVDY. Anyway, this list and the max factor is only for funds that have been around a year. Like I say, that's until today, but this, I saved this chart last night before I added MSTR and MSTY. All right, so max factor, number one fund, NVDY. Okay, number two fund, is TQQQ, is triple leverage NASDAQ. Number three fund, Coney. Number four, InFly. Number five, NFLP. Look at this beast. People don't talk about NFLP that much. Hell, it only got 40% last year with the 24% divvy return. I mean, NFLY is awesome too. It's one of the, but you could see it's way up there on the max factor. It's great risk-adjusted reward, tons of reward for how much risk you have. Well, it was up 9% on NAV, but it paid about double the dividend for a total return of 55. But NFLP actually out total return YieldMax, which is what you'd expect, because usually when you have less yield, you have more total return. So that's the way it's supposed to work. Coney, on the other hand, look at Coney, it was down 30% for the year, but up 80% on div. So about a 50% total return. Then, of course, I mean, NVDY is the beast. It was up 25%, or I mean, it was up 20%, 17%, and made 92% on div. I mean, that's crazy. Okay, but then I have different factors too. So the Z factor is a safety factor. So if I was allocating for someone that was highly concerned about NAV, that's really like a NAV truther, and they're out there. I saw somebody yesterday. It just doesn't believe total returns the real thing. It's just all about the NAV return to them. Well, that's fine. I made a metric for those kind of people. Even with those, okay, with those kind of people, of course, TQQQ is great because you have tons of NAV. TQQQ, I shouldn't have put it on here. It's going to be the top of all the, it's just leveraged NASDAQ. So I'm sorry it's even on here. I need to figure out how to take it off. But so the safest of all funds, look, NFLP. And look, NVDY made the max factor list, which is the more risky list, and it made the safe list because it has elements of safety too. Hell, it was up 20% last year and paid a 92% dividend. How much more safety do you want, right? All right, and then we have the perennial safe funds, SCHG, CLM, great fund. Look at CLM, up 25% on NAV and it paid a 17% divvy. Hell, what's not to like? 42% total return. Hell yeah, dude. Then we have AMZP on the safe list, not AMZY, AMZP. This one returned 23%. It only had a div return of 16%, but total return of 40%. So it just depends. Are you into safety? You can use the Z factor. If you're into the same stuff I am, you can use the max factor. But there's not only one way to do it. Then there's something even more aggressive than the max factor called the Y factor, the YOLO factor. You can use this if you're really aggressive. It's just a different way of measuring the same thing. I think max factor and Z factor is really all we need, but I was just looking. But on the Y factor, it gives you the same kind of stuff. The Y factor actually doesn't give you TQQQ because the Y factor figures in yield. The Y factor is for a yield chaser. I should call it yield chasing. But anyway, you would have your fund would be NVDY, CONY, NFLY, FIBI, and AMZ. If you made a 5-person Dorsey Wright fund, that's how you would do it. So I use these to allocate these metrics to allocate my own portfolio, my family's portfolio. And I thought you guys might like it too. I'm going to make them a subscription service, I think. I don't know. But anyway, right now I gave them to a couple of my subscribers free to kind of beta test them and mess around with them. So anyway, but in case any of those subscribers are watching, I kind of want to explain how it works. You just, X factor is another thing. You can go sort column Z to A, and this will give you the X factor. So this one's NVDY, Coney, TQQQ. I really didn't know. I made so many factors, I didn't really know what to do with them. I'm telling you, all you need is the max factor and the Z factor, unless you're chasing yield, and then you need the YOLO factor. Anyway, now these things are based on a year. When they're a subscription service, the year's too long of a time period. I'm using a shorter time frame. The reason they're a subscription service is because it's a pain in the ass to maintain this database. If you guys like this and want it, and there's people that want to subscribe, it'll be some kind of nominal charge, $5 or something. But if you guys like it and want to subscribe, that's great. But if no one really likes it and cares anyway, that's fine. No one will subscribe. Then I won't waste my time doing it, is all I was thinking. I mean, but I've got a lot of use out of it. Even if you don't care about my factors, you can get a lot of use just studying the NAV return and the div return of all these different funds. This is half of my retirement simulator. My retirement simulator, is not part of this. I'm not trying to give that away or sell that or whatever. I'm just trying to, but this database I think might be helpful to people because you can go and you can organize. You can organize by category. You can hit sort Z day. Okay, so this shows you the REITs. I only have one REIT. Oh, well, let's see. Oh, well, O has a shitty freaking max factor. So we'll scratch O off the deal. But TQQQ, that's leverage growth. That's the one I have in there. Gold is an inflation hedge. Now, XBAL is hedged growth. Z hedge from Zega, that's hedged growth. Then we have SCHG growth, QQQ growth, SPY. Anyway, but this is, you could study it, and then you can look over here at the NAV return and the dividend return. You can see Max's math here. Like I've always told you guys, NAV return plus dividend return equals total return. There's only 3 numbers to it. And all I use to calculate this is I take the 12-month dividend. So on QQQY, that it's paid a $25 freaking dividend in the past 12 months. Okay, it was at $52 12 months ago, it's at 33 bucks today or yesterday, whenever. NAV return down 36, dividend return plus 48. Difference is 11.69. What did I say on my? I made a video that pissed a lot of people off called True Yield. And what I did is I normalized a bunch of funds yields to if they were managed the way JP Morgan's JEP-Q and JEP-I are managed, what would the true yield be? And on the Defiance ones, I said 8 to 12 or something, or 10 to 12. Anyway, that's exactly what they got for the year. And I think that's good. But anyway, if that's not good enough for you, you can, you know, somebody like you can, let's do this. Let's say, let's just sort it by NAV return. Let's say, hell, I'm not going to invest anything that invests less than 50% or makes less than 50% NAV return. Anyway, here's your NAV monsters right here. You know, XVOL, Q, SPY, IWM, AMZP, whatever. Okay. Now let's do here's the ones that are destroying wealth. It doesn't mean they're bad investments necessarily, but they work a little different. But so IWMY is at the top of that list, and people love that freaking fund. You know, AMDY. I mean, I put AMDYs in my family's portfolio. But you know, I love AMDY. But also it was high on the max factor. Or I made the family portfolio. The latest one I did is just a high. They just wanted to go for yield. They already have plenty of other stuff. So I just made them a yield one. I put NVDY, Coney. Well, I didn't put InFly in. I'll explain why. I put FIBI, AMZ, and AMD. Then I put Triple QI, and then I put FEAT, which is the new Dorsey Wright. But I used the max factor, or I used the Y factor to allocate that, because that's if you want somebody that's just trying to get yield and they aren't super concerned about NAV return. That's a metric for that. Anyway, I feel bad that I shared this with two people and haven't shared it with other people. I'm not trying to be like that. If anyone wants this just for research, if nothing else, just to kind of see NAV, you can't really do that much with it other than just sort it. And if you kind of want to see how the factors work, you decide this is for the year. The factors that use the shorter time frame will be more accurate than this. This is just for the past year. But anyway, it's the same thing. You can see how it works. I'd be happy to share this with anyone if anyone wants it. I guess I would. I'm trying to think about that. Yeah, I mean, it's yeah. And I'll also share with the other caveat, this isn't anything complicated. These formulas are all off-the-shelf formulas you could do yourself. You can make this whole spreadsheet yourself if you were so inclined. The maintaining, every time there's a new dividend, making sure it goes in here, and the maintaining the database is the thing that's the pain about this. But anyway, if somebody wants this database just to be able to sort stuff, you know, yes, I'd be happy to share it. I'm gonna do it right now. I'll put it in the. I have a burner account here. Mike's my real name, but Bridgeway's not my last name. But I've used so many freaking Google Sheets accounts, and I'm over my data limits. I'm going back and forth between four, and I pay, and I subscribe under my real name. I subscribe to Google and pay for their storage. I have an Apple. I pay for storage stuff. I'm still going over the limits because of all these freaking spreadsheets. And anyway, but yeah, I would be happy. So anyone with the link can edit it, but there's no formulas in there. So you can do whatever you want to it, but you can't see the formulas. But like I say, you could figure them out yourself. Go, you know, anyone could easily do this themselves. I'm not saying I'm the only one that can do this or, you know, anything like that. All right. So, here's a chart. I thought this might be interesting. So this is the last graph we looked at, okay? So this is sorted by Y factor, which is that yield factor or YOLO factor, okay? So NVDY, Coney, InFly, FIBI, AMZ, AMD, PP, PayPay, PP, whatever, IWMY. See, IWMY with all that NAV loss had a lot of yield, so it's still fairly high on the YOLO chart. You know, but you aren't going to find it high on the Z chart, on the safety chart. Okay, but anyway, let's stick with this one. But I just thought it was interesting. You could see here. So red's dividend return. So you can see generally the higher, this is basically, you could almost just sorted it by dividend returns and got a similar chart. But it's a little bit more complicated than that. But you can see the red's the dividend return. So the yellow is the total return. And once again, there's huge total return over here on TQQQ. TQQQ is not high on the YOLO yield chart. Why? Because it has no yield. TQQQ is not a high yield fund. It's just I don't even know if it pays it. It doesn't even pay a dividend. It's just leveraged NASDAQ. Or if it does, it's a small, it may, but it's a small one. But they have tons of return. So the return factors in also. The total return, div return, and NAV return all go together. And that's what I thought this was trying to show. You could see some of these down here, like XVOL had a low Y factor because these down here don't pay any yield. Look down. The yield is, the yield's not even on this chart. But the reason these are down here is generally because they have a low yield and a low return, maybe, or some combination of a low yield and a low return. This is for yield yellowers. All right. Instead of Dorsey Wright, this is the max convexity income allocation. So it'd be, and I don't think 5's enough. I'd do 10, NVDY, Coney, and I wouldn't use just YieldMax. I'd use anything that came up. But anyway, the top 10 yielders right now is NVDY, Coney, Infly, Fibby, AMC, AMD, PayPay, IWMY, and NFLP and Sky. So one of the curved ones slid on there. Think about that. That's awesome. I mean, those curved ones, that NFLP is something else. Just the math of the curved ones looks really nice. They don't have the yield of the YieldMax, but in some cases they have better or as good of risk-adjusted reward, which is what it's all about. All right, guys. Well, I'm gonna let you go, but I will share that. I'll share the max factor with anyone who wants it. If you guys got any questions, hit me up in the comments. I'm gonna be here all day working on videos, and all day tomorrow, and all day Christmas. I'm having a marathon work session, getting my channel caught up. I got behind the past couple months, but anyway, we're going to be getting caught up over Christmas. I appreciate you guys being here. Don't forget you can like and subscribe. Don't forget you can even leave me a PayPal if you want to spread some Christmas cheer. I don't even put my PayPal address on the screen. I used to put it at the bottom of the screen, but then it bothered people, and then I got some bad comments. I'm like, that's fine. I'll take it off. It doesn't matter. But anyway, it's paypal.me/maxconvexity. All right, guys. You have a good day.